Welcome to Barchart's weekly series of webinars designed to help you, the trader investor, better understand a variety of trading ideas and concepts, as well as the pages and tools Barchart provides to help you to make a more informed investment decision. Today's subject, long straddles. So this relatively simple strategy is where an options trader purchases both a call and a put at the same strike and expiration. And the trade plan of the strategy revolves around the trader's belief that the underlying security is about to have a quick price movement in either direction or to profit from a rise in its volatility. Hello, my name is John Rowland, and I'm going to hopefully today get into looking at long straddles, their aspects, and Barchart's long straddles screener page. Plus, also give you some food for thought to help you select some potential candidates. Today with me, as always, is my faithful partner and our moderator, Jean Baker. Hello, Jean.
Good afternoon, John. Good afternoon, everybody out there as well.
Yeah. So, Jean, let me ask you kind of a, I don't know, is it a rhetorical question? I don't know, but have you ever been on the fence when it comes to a decision, especially when you're thinking about something to purchase?
All the time, John, all the time.
Well, let me give you a quick example. So over the weekend, I was with my daughters and we went to one of the Memorial Day weekend sales at an outlet mall, and we were in this store and they had the rack of like everything on the rack was 80% off, and my daughter was sitting there and she was like trying to decide between two T-shirts. It's like, which one should I get? Which one should I get? And I'm like going, why don't you just get them both? They're 80% off. At least the two of them together is less than half of what it would cost for the original one, right?
Right.
Well, long straddle is kind of like that. Is we don't know which way price is going to go, right? We just know that it's going to move. And so this is the way we can take an option strategy to try to capture that price movement in either direction. Does that kind of make sense? I don't know.
Of course it does.
All right. So let me get my screen started. Okay. So again, our disclaimer is that all trading has a form of risk. It's important for that before you take any investment decision that you understand risk and how it fits into your risk profile, and if you have the financial ability to bear that risk. And we at Barchart always recommend that you seek the advice of a qualified financial professional before taking any risk or investment strategy. Okay. So let's get started by looking at some base information and understanding of what the strategy itself is. Okay, like I said before, I mentioned it's a limited risk and unlimited reward scenario, right? And then we're looking for a large movement in price or an increase in volatility. So the position again is long a call and long a put of the same strike and expiration. And one of our keys to success is going to be this catalyst. We're going to look for some catalysts to help us get this price movement. And so we can think about things like corporate news, right? For instance, earnings reports, definitely a great catalyst for moving markets. Maybe introduction of a new product line, like when Apple introduces a new phone, or a drug company coming out with a new drug. Another corporate financial activities, maybe the CEO is going to retire, or a special dividend, or something in that realm of the world, right? Okay, but it doesn't have to be stock specific. In other words, corporation specific. We can also look at bigger picture, right? The broader economic news, for instance. Some of those examples would be, like an unemployment report or non-farm payrolls. And, one of the ones that, you always hear folks talk about is, the Fed notes or Fed rate cuts or Fed raise rates. And so, this one, in the past, the last few years, the Fed has cut rates so much that it didn't really have much an effect. But I think as we move forward over the next 6 months to a year, this kind of strategy might work well with Fed announcements, especially if the Fed goes to what they call a tapering. Okay. Right. Break even and maximum gain and loss. Right. Our break even is the total cost of the two options, plus or minus our strike price. Okay. We'll look at that in a second. Our gain, in theory, it is unlimited, but in reality, it's really kind of limited to how far price will move from our strike before expiration, right? Without exercising one of either one of the puts or calls, right? One of the legs. But we also can see a potential profit if we get a rise in implied volatility. Our loss, again, is limited to our total purchase of our price. And again, in this one, in reality, this is where both options expire worthless. That's only happens if the price of the security settles right on the strike, right? So even if we are a little bit above the strike, a little bit below the strike, one of the legs leading up to expiration will have some value, be it only might be minimal, all right? So again, our loss is limited to the downside. All right. All right. So here's a kind of a picture of the setup. This is Pfizer, and the long straddle page screener picked this up a few weeks ago. I think the date was May 20th, if you want to go back and look at it. And I was looking at a June monthly expiration, and so just to give you a little background history, each individual leg prices, the call was worth about 90 cents and the put was worth about 80 cents. So the combination of the two, right, the long $40 call and put gave us a total net debit of $1.70. So what's our break even? Well, our break even is plus or minus that net debit. And so you can see that our break even to the upside is 41.70 and our break even to the downside is 38. 30, okay? So let me just do this first. I want to go to current Pfizer market, just to give you a kind of look-see what this has been doing. Oops. And let me get here, hang on. So here's Pfizer today, right? And you can see that our straddle kind of is working, right? Price is moving a little bit more dramatically to the downside. And in what, 5 or 6 days, we've gone a little bit lower. But we haven't reached that break-even level. So, just kind of show you where the value of this is. And I can come back into my Pfizer, and I'm going to pull this menu down. And look at straddles and strangles, and here's long straddles. And again, this is just got a quick comparison. I just want to kind of show you what's going on with this one. And I'm looking at long straddles. And you can see the $40 straddle right now. Yeah, it's worth about $1.24. So the strategy itself is still holding value, but we haven't got outside that break-even level. So we're not really there yet, okay? All right, let's go back to our slides. Okay. All right. So what are some of our risks? Well, our risk in dollar terms is really just limited to our total purchase price, right? But one of the other risks that we need to be aware of is, and the success of the trade is that the passage of time will cause a risk to us. Or in other words, it's going to eat away or erode from the value of our strategy, as the example I just showed you in the Pfizer. And for options traders, this is called theta, right? The decay of our options. How much does our option lose in value as a passage of time? So if our stock price doesn't move, or it hasn't moved a lot, that big price movement, relative to recent price, then we will suffer a risk or this loss of theta. Okay. Um, if we hold the position through expiration, we also can take on another risk. And that risk could be from the fact that we might exercise one of those legs, or that our broker will exercise for us. Normally, a broker, if you have a leg that's in the money, they're going to exercise that leg for you unless you close out that position. So one of those risks would be the risk of exercising, and in particular, let's say the risk of ownership, right? Becoming an owner of a stock, in other words, a capital risk, and then from that point on, the risk of the price of the stock going up or down. All right, so what are some of our keys to success? Well, as I mentioned, some event to price movement, right? We need kind of a catalyst. We need something to get price movement. Now, it can be something like a corporate event or a larger, broader economic news, but we'll look at some other things that maybe could help us determine if we're going to get a price movement. We're going to look for candidates with lower implied volatility rankings. Now, the thinking here is the lower the implied volatility rank, the cheaper the options. The cheaper the options, the smaller the price movement I need to achieve break even. So we're looking from a low volatility environment, anticipating a high volatility environment. Okay, and we're looking for something that's cheap, right? Remember the discount rack? That's kind of the theory behind this. Looking for smaller debt outlays. Again, the relations here, the cost of the outlay to the price movement, right? The smaller the outlay, the smaller the distance to our break even. And we'll use this a couple ways to do some comparisons, all right? Longer dated options. So here we're going to talking about two concepts. First, something that we've discussed before in many of our option strategies is that monthly expiration options have greater liquidity. What is liquidity? Well, it just means they have more volume and open interest. And so what that does for us is it helps mitigate a little bit of a risk, especially when we look for an opportunity to get out of this position or to exit the trade. So therefore, it's a little bit easier to exit our position, be it right or be it wrong, because of the greater liquidity. For some of you, you've already experienced this, right? You've traded weeklies, right? And you found yourself chasing price to get a fill, right? Because there's not a lot of liquidity or the bid ask is super wide, right? So that's why we kind of want to lean towards our monthlies. Now, there's a second reason too, is when we look at expirations, right? The further out in time, right? That helps decrease the offset of our theta decay. How much does our option lose value on a day-to-day basis? So the theory behind theta is that inside about 20 days prior to expiration, that's when your theta really starts to kick in. That's when theta becomes almost exponential, right? So we kind of want to look at longer dated options because then our thetas are going to be a lot smaller. That'll allow, give us time, for instance, for that price movement, that spike in price movement, but also hopefully our option will hold some value and not be subject to this decay. Excuse me. And then finally, we're going to do a little chart analysis, right? We're going to find candidates that meet the criteria above, but with chart patterns that could prove to be another catalyst, right? So, we'll look at candlesticks, maybe some candlestick formations, but, some of you maybe use Bollinger Bands, the idea of coiling and expanding, or MACDs, or some of you might prefer using stochastics or RSIs and you're looking for divergences, right? So we'll look at these types of patterns, chart patterns, or you could look at one of these technical analysis as an odds enhancer to price movements if you don't have one of these other catalysts, for instance, like earnings or some type of broader economic news. Okay, all right. So that's kind of keep that in mind as we go through our process. All right. So I'm in the screener page. Now, just to show you where that is, here's options off of our main page. Here's our straddles and strangles, and here's our long straddle. So I've gone to the long straddle page. All right. So the page is sorted by the break-even probability, right? And the calculation can be found here in this help section, right? I'm going to scroll down here. There's our probability calculation. And basically what it does is it takes into account the stock price, the break-even price, days to expiration, and the 52-week implied volatility. Now we're going to talk a little bit about this in a little bit more detail. But just initially, that's how our page is sorted, okay? All right, so first of all, our symbol, right? Now, all of our screeners or all of our screener pages, symbol is our default. But I want to, show to you folks that if I click on this X here, or this little cross here, this opens up a little bit more information about individual stocks. And what's kind of nice about this one for what we're going to look for this scenario, for this option strategy, is I can get a quick little price chart here, just a quick snapshot. This is about a month's worth of price action. And in this instance, for this stock, you can see it's kind of looks like, if this was a heart patient, we probably would have called in the priest, right? But over here, here's our headlines, right? So you can look real quickly to see if there is a headlines, if there is a catalyst. Now, I'm not going to go deep into the woods in here, but you do see that there is some kind of shareholder alert. There is some news or something that's going to happen to this stock. It could be class action suit. It could be, a lot of different things. But, also you might see your earnings in there, or, a CE announcement or something, CEO announcement or whatever. So there is a way for you to quickly look for some headline news, all right? All right, our price, what is the last price? That's obvious. Our expiration dates of our option. And, for us seasoned options traders, it's really easy for us to look quickly at this expiration date and determine if it's a weekly or monthly. All monthlies are on the third Fridays of the month. So, you can kind of judge that by the date. And then the next four are strike, delta, leg ones, and leg twos. Well, we know this is a straddle, so we're going to have the same strike, right? So we're going to have, in this case, a $10 strike for this particular stock. But we also have our leg delta 1 and 2. So when we talk about deltas, a call delta is always represented in a positive, and a put delta is always represented in a negative. So if you look at this, you can tell that leg 1 is our call and leg 2 is our put. All right, and we'll go in a little bit more detail about what delta means to us and how we can use that as well. All right, what's our net debit? How much is the cost, right? The cost of this strategy. Now, our net debit, the way we do it is we take the current ask. Now, remember we talked about that liquidity issue. So if we're looking at the ask of both legs, our cost could be a little bit greater, right? We could, in theory, look for an opportunity to buy this a little bit cheaper, when it comes to actual execution. Maybe we could try to middle or try to do some kind of timing or legging in of that on a day basis, right? But if we're just looking here, we're just looking at the total ask of the two legs, all right? Percentage of stock, right? So what we're going to do here is we take our net debit and then we look at it as it relates to in a percentage of the stock price. Again, for this one, we're going to look at this as a comparison too, but the smaller the percentage of the stock price it is compared to my net debt, that's how much price has to move for me to get to that break even. Again, I'm not going to look for a long straddle whereby, my percentage is, 20 or 30 or 50%. Let's see what examples it gives us here, right? You know, if I have to get a 30% price movement pairing my stock, that's probably not something that I want to do in terms of a straddle. I might use some other option strategy. Remember, because I want to buy something cheap, and if I'm paying for 30% of a price movement, I'm probably paying a lot for that, right? So here's a lot of them that are lower. We'll talk about that in a little bit more detail, all right? What's our average implied volatility? Again, this is the average of our puts and calls that are immediately above or below our current price. And again, this will be more of a comparison for us. Our break even, our BE plus or minus, again, this is our net cost plus or minus our strike price. And, I'm going to use this when I do my chart analysis to see where my breaking even is and how does it line up with my chart patterns or where I believe price could move to based on support or resistance or supply or demand or however you want to define it. And then again, our probability, the likelihood of price reaching break even. Now, when we talk about markets, right, and especially options markets here, the market does a really excellent job about pricing break even, right? This kind of efficiency, right? In other words, the cost to achieve break even and the probability is usually spot on. Matter of fact, that usually the market makes you pay a little bit more, right? So this is why we kind of want to be really sure about what we're looking for and also how much we're paying for it. Think of it like in terms of, Vegas when they have a sporting line, like for instance, the NFL and the point spread, right? How many times have you seen a point spread, let's say was like 6.5 points, and the final score was like either +6 or +7, right? I mean, it's amazing how Vegas picks those point spreads and the outcome happens to fall right on the point spread. So the point being here is that a higher probability doesn't always equate to greater success, all right? Just keep that amount in mind, all right? Okay, so right now we have 156 potential candidates for us to dig through. So, I think this is a little bit too much for us to dig through, right? So let's go inside of our filter, our screener filter, and let's just make a couple minor tweaks, right, to our defaults to help us narrow down some candidates. Now, remember, there's no right or wrong, right? And what I'm going to show you doesn't necessarily mean it's going to happen, or that it's worked for me in the past doesn't mean it's going to work for you in the future, right? That this disclaimer part. It's all about you, right? And your own trade plan and what variables that you want to incorporate in your analysis, right? Or how you want to look at it. But let's just look at it making some minor tweaks here. Okay, so the first one I would think about tweaking is our days to expiration. Now, we talked about monthlies and weeklies, so maybe I'll just get rid of weeklies, all right? And we also talked about that inside of 20 days, our thetas are much higher, right? So maybe I only want to look for opportunities where I'm outside of that 20-day window, right? I'm going to look for options, strategies, strikes, and expirations where I have a little bit more time, but also I'm not worrying about that increasing theta, right? And if I just do that, get rid of weeklies and change my expiration, now I've knocked it down to 34, all right? The other minor tweak that I'm going to do is scroll down here to my net delta. Now, net delta here is where we take the difference between the call delta and the put delta. And what we want to try to strive for here is try to get close to 0. And this equals the probability of price movement, right, in either direction. If I can get it to 0 or close to 0, then the market is telling me it can go either way, right? If I have a skew one way or another, a positive or a negative, then that is telling me the market has already given a bias. So I really kind of want to narrow this net delta down. Notice our net delta here, we give you a range of 10 plus or minus 10. So maybe we'll lower this down to 5. Okay. And again, if I set my results, you'll see now I've really narrowed down this number of candidates, right? So now I can start really kind of digging into these different candidates. So we do have some other ways for you to help you to do some assessments. And so one of the ones is here under our main view. If we open this up, we can also go right to dividends and earnings, right? So we can look up these 19 candidates. When is their earnings announcements, or when they might have, announcing some ex dividends. And again, I want to find ones where earnings could be a catalyst for price movement. In other words, I want to see my earnings before my expiration date, right? So that would be a good example right there, all right? But let's say that I know for a fact what my expiration date is, or a window, right? Maybe I'm looking at a longer term time, maybe 45 days, maybe 60 days, maybe even greater than that, right? I can come back into here, into my filters, and just type in earnings, right? Earnings date. And this will allow me to set a very particular time window, right? I can actually put in the dates of the window that I want to look for, right? Maybe a certain 3-week period or 1-month period or something to that effect, right? So there's a couple ways we can look for earnings as a catalyst, either through the filtered view, or I can incorporate it into my filters. I can bring that assessment in. All right. So we also have a view which is called our filter view. And our filter view here is going to give us, again, some of those components that we already have as our default. But when we go to look at maybe adding some additional filters, which I'm going to show you in a second, this is where we'll find that information. So on our filter view, our defaults is our days to expirations, our probabilities. Now here you're getting to see, your volume, your open interest, again, your net delta. So those are some of the things that are in the default. Now, if I wanted to create a filter of my own, or I wanted to incorporate some variables or inputs that I feel that are important to me, there is a lot of ways I can do that, or there's a lot of places or information that I can use. So I went back to set filters here, and I'm just going to show you a few to start off with. First of all, under the options analysis, right? Strike volatility, some of you might be interested in that. But the two that I'm really particularly interested in is theta, our sensitivity of our options value to the passage of time. And again, remember, the greater the theta of options are those who are 20 days out or less to expiration. That's our enemy. Theta is our enemy for this strategy. And our vega. And now vega is the sensitivity of an options price to the change in its volatility, right? And all options become more valuable with rising volatility, our ally, right? So remember we talked about long dated options. One of the reasons why we want to look at long dated options, we said that the thetas are a lot less in longer dated, but also on the other side, vegas are greater for longer terms than shorter terms. So let me give you an example of that. Let's go to a very common stock. Here's Apple. And here I'm looking at the June 11th weeklies, and Apple's trading around close to about 125, 124, and you can see our vega here for our 125s and 124s is about 0.07, right? 0.077, right? If we want to round it up, 0.08, right? And if we look at our monthlies, one more week out, right? Not much time difference. You can see that our vegas are 0.1, again, greater vega. So this is one of the keys for us. This battle between theta and vega, right? And that's kind of why we want to lean towards these longer term strikes and expirations, okay? All right. So I want to show you my screener, right? So some of the elements that I've incorporated in, and if you don't know how to set your own screener, we do have some tutorials, and I've done webinars about how to set screeners. And again, if you have any issues, you can always send a question to support, right? So here's my long straddles. This is the things that I feel that are important for my for helping me break down this strategy. Okay, so first of all, I have my leg one strike. Now, it doesn't matter if I use leg one strike or leg two strike, they're going to have the same strike value, right? Because we're talking about a straddle. My net debt, we already talked about that, my net debt. Percentage of stock, we've talked about that as well. And then these three inputs, net theta, net vega, and net delta. And here I'm going to do that comparison. I want to look for, in this particular strategy, I want to make sure that my vega is greater than my theta. Now remember, theta is going to be represented as a negative because that's our enemy, right? It's always destroying or decaying our options. And vega is an ally, so it's going to be represented in a positive number. But we're just going to look at these as absolutes, right? And what I don't want to do is look for or find a candidate whose theta and vega are close to each other, or that are the exact same, or even if my theta is greater than my vega. I don't want that. What I want to do is find ones where my vega is greater. Now, I can't really give you a threshold here, or this is kind of a give and take. It depends on how much time, depends on the price movement or the pre-volatility. But, kind of a rule of thumb, maybe if we can get a 2x or a 1.5x, then that would be somewhere I would start looking for. Certainly, if my vega and theta are about the same, then I'm going to pass on that opportunity. So, there's looking at here, I'm just kind of eyeballing here for a second. If I can see a good example. Well, I mean, this one is not a great example in terms, but it is 2 times. Here's one that's 1.5x, right? So, can start looking at that. All right, my net delta. Again, the difference of the deltas of my 2 options, my put and my call. Again, I want to try to achieve as close as I can to 0. Again, if I have a positive number, it means that the skew is towards the call. If I have a negative number, it's towards the put. And again, the closer I get to 0, I can set a strike that doesn't have a skew or a bias one way or another. Now, if I have a bias and I'm setting up a straddle, maybe I found a strike price that I feel that price is more likely going to go up or down, then maybe I would look for a positive net delta. Or if I feel price is going to go down, I'll look for a negative net delta, okay? Our IV rank, and again, we can find IV rank in our filters under our options overview. Just want to show you where it is, all right? And our IV rank is based on where is our volatility today as it relates to over a year, right? Over the past year. And again, our theory here is we want to look for a low IV rank in terms of helping us to find cheaper options. So this one, I can give you a threshold. I think you got to look at like 10% or below, right? Below 10%, right? Then I have my 1 month IV rank. So this one doesn't have to be under 10%, but what I might be doing here, and this is kind of how I use it, is I want to see if my IV or my implied volatility is rising, right? And in terms of between 1 year and 1 month, right? So I might, for instance, in this one, the IV rank was 15 based on the whole year, historical volatility, but in the last month, implied volatility is rising. So here I'm seeing a rising volatility, right? That's kind of what we want to look for, right? Now, this is an extreme example. I still would probably want to find a monthly IV, which would be around that threshold of 10 or 15 or 20%, especially if I had a low rank IV, right? So that's kind of what we want to do here. We want to kind of look for that comparison, all right? All right, implied volatility, I just have that there because I just use that. Doesn't really do anything for me in terms of eliminating or finding potential candidates. I just like to have that number available to me so that if I do any kind of other historical comparisons, I have that number available to me. Okay, what's this one? 5D OI percentage change. Okay. So this stands for a 5-day open interest change in a percentage, right? And what I'm doing here is I'm using the principle of rising open interest as a sign that investors or institutional players are committing new money to this particular stock, right? What I want to see is, as I'm putting this strategy on, do I see a rising open interest? Do I see my institutional and my traders adding new positions, right? That's kind of giving me the clue that they're kind of looking at the same thing that I'm looking at. And again, as far as a threshold, you're gonna have to play with this, but 3%, 5%, 7% increase in a week's time, that might be significant enough, right? But I don't want to see is a negative volatility, or excuse me, negative open interest. What is happening there is telling me that my traders are closing positions and they don't really care about that particular stock, right? 20-day ATR, or average true range. So here what we're using is a metric of price movement called average true range. Average true range is a measurement of volatility, but the result is given to you in a price, not in a percentage. And what we're going to do is we're going to compare our average true range to our net debt. And just like we did with the Theta Vega comparison here, what we want to do is we want to see how close we can get that ratio of our net debt to our ATR, right? Remember, our strategy says we're looking for a quick price movement in a short period of time. And if my market moves on an ATR in this example of about $2.40 of range in one day, if I have multiple days of price movements, right, how fast can I get to my net debt? And you can see that would only take, in theory, 2 days, right? So again, as far as a threshold, 2x, 2.5x, something to that effect. The closer I can get to 1, the better. Unicorn, you're not going to find a 1-to-1. Very, very rare. But if I'm outside like 3, 4, or 5 times my net debt to my ATR, then maybe I'm paying too much for that option or that option strategy. Okay, so that's why I like the ATR. DTEs are days to expiration. There's our probability, and then our open interest. Again, the first column here, open interest, is our call open interest, and the second leg is our put open interest, and this is the open interest of our strike price, right? Not open interest of all puts and calls or all open interest, all the options of this particular stock is very specific. It's just for the strike. So again, in this one, what I'm doing here is in the general terms. Normally what we'll see is that you'll see a greater open interest to the calls. It's usually about less than 2 times, usually. So what I can do here is I can look to see if there's a skew. For instance, here you can see that in this particular stock, there's a lot more open interest on the put side. So the market is already telling me that it has a bias to the downside. So that could be significant to me, especially when I do my chart analysis. If I get a balance, right, market is telling me that it thinks that it could go either way, but it's actually because we normally see a 2-to-1 ratio or a little bit less than 2-to-1. It's actually again telling me there could be a little bit of greater bias. If I see, for instance, on this one down here, where I see 25,000 versus 2,000, now the market is telling me it has a bias to the long side, okay? All right, so those are just some of the basic concepts, some of the basic food for thought for us to think about when we go to looking for candidates, all right? So I see a couple questions here. So let me pause for a second and look at some of these questions. But what I want to do now is I want to go to flip charts, and then I also want to start thinking about these price movements, all right? So I see my buddy Aaron is in the house. Hey, Aaron, how's it going? He says, can you share your thoughts on how positive theta impacts a long straddle with low volatility, whose assets, whose IV is rising over time? So again, Aaron, it's not a positive, it's actually theta is a negative, right? And again, I think what you need to concentrate on is finding those opportunities where we know there's going to be a catalyst to come outside of 20 days, right? Outside of 20 days to our expiration, right? Now that not always can happen for us, right? But if I know that I have an event that's going to come up and my expiration for my strategy is not for another 20 or 30 days or 45 days, that would be a good thing. If I'm looking at an expiration that is 5 days out or 7 days out, and I have a catalyst earnings, for instance, that's only 3 days out, right? Now I'm really fighting theta, right? So I need that price action to be really, really extreme for me to make money on this strategy because I'm fighting that negative theta. So that's a really good question, and I really appreciate it. So here is advanced micro devices, and I kind of want to show you this one because this is a trade that I looked at just recently. And so, and this kind of builds on what we're going to work on in this next segment, is what I saw here was that advanced micro devices chart pattern was coming into an area of consolidation, right? It was kind of just trading back and forth. And I picked this number of $81 because it doesn't look like it was kind of just floating back and forth up above and below $81, right? And all of a sudden, we're starting to get close to, and that's what this yellow circle here on April 27th, we're getting close to earnings. And that was the date the earnings came on. But I'm looking at a longer dated option. I'm looking at an option that is going to expire in May or June, right? And this is kind of what we see a lot of times coming into an earnings announcement, is that volatility starts to pick up or price movement starts to pick up because of the whisper numbers or whatever is going on. And then you can see that the earnings came out in the evening, and then in the next day we had this big price movement, right? A spike in volatility. But I want to show you that, this trade worked not only because we had a spike up, but look how much price moved in a very short period. In 2 weeks' time, right? I still have a month out before my option expires. This price movement of about $17 or $18 from the high that it made here to this low down here came in a 2-week period, and then volatility did pick up. Matter of fact, in this example, our implied volatility went from like high 28, 29, I think was where it was, to 40. So we picked up about 10 to 12 points in volatility. So the strategy worked. And I didn't really care which way price was going to go. I just knew that earnings was going to create that catalyst, that price movement, and there we got that price movement, right? We got it in both directions. So I think that kind of answers your question, Aaron. So hopefully. All right, so let's go back to our screener. All right, and I'm going to go to flip charts, And let's see, I had Apple that had popped up earlier. Let's see if any of the ones that I was looking. Of course, Gene, right? The ones I looked at this morning are not there now, right?
Of course, that's the way it always goes.
It's always that way, right? Okay, so well, I did look at IBM, and this is kind of what I'm talking about, right? Here we are coming into a cycle of coiling or contraction or consolidation, whatever you want to call it. And, if any of you were in my chart patterns webinar, this is kind of an ascending wedge or a breakout wedge, however you want to call it. And I don't know which way IBM is going to pop. I just have a feeling, right, that once it gets above this high or gets below this uptrend here, uh, that it's going to move, and it's going to move, dramatically. So what I could do is now say, well, where's the upside to this? Well, it looks like about, from 145 to about 148, 149, maybe $4 up, and to the downside, maybe down here from 145 to 138. So $4 to the upside, maybe about $6 or $7 to the downside. Now remember, we talk about the efficiency of markets, right? And if we look at IBM, right, it's making me pay $7, right? So the market is already making us pay for that price movement, right? So maybe this is a chart pattern that I like, but the cost is not there, right? So let's see if we can find a better example, all right? Intel was another one that came up. Is Intel up there? Okay, good, it is. All right, cool. All right, so again, prices come into a cycle of consolidation after testing a recent low, right? I don't know which way it's going to go. I see that there's a lot of room for it to run to the upside. There is absolutely nothing in its way in terms of price action, really. And that we do have a recent low that we kind of bounced off of. But at a higher time frame, maybe we could even say it could go a little bit lower, right? Again, from where we're currently at, right around $57, how much could it go up? Well, it looks like it could go up about $5. How much could it go down? $5. Again, let's look at Intel in terms of our strategy. And okay, a little bit better, right? So here we're seeing that we see price movement can move about $5, but it's only costing us $2.29. This would be a better candidate for our long straddles because our cost is a lot smaller than what we could potentially see in our price movement. So what I'm going to do from here is then I'm going to look at my delta to vegas, make sure that that's my theta to my vegas, make sure that's right. What's my percentage of my stock, right? Is my rank, right? It's a little bit above 10, but my implied volatility is rising. And, I could come back in here and then look at earnings and see if earnings are going to be a catalyst for me. And so let's see, Intel, right? My earnings is on July 19th. Now, I believe this option is going to expire before that. I think it's July 16th. So earnings would not have an effect on us or be that catalyst. But a lot of times, you've noticed that we do see implied volatility rise as we get closer to an earnings event, right? So this one has a lot of good merits to it in terms of pricing and price structure, but we don't have that catalyst, right? We don't have that catalyst. Okay, let's go back to our filter view. The other one I saw was Netflix. Let's see if it's still up there. Oh, yep, there it is. Okay, Netflix. Again, kind of similar to what we just looked at, right? Where do we see price movement could go? We're right around $500. Looks like about $40 to the upside and $40 to the downside. Again, I'd go back and look at Netflix. How much am I paying? Right? I'm only paying $20, right? So again, this would be one of those ones that I would look at, right? It would fit my candidacy, right? And then the last one I saw was waste management. Let's go back to our flip chart. And let's see, it would be one of the last ones. There it is, waste management. Again, this is that typical chart pattern, right? That wedge or triangle or whatever you want to call it, right? We've come into an area of consolidation, right? How much do we anticipate price moving in one direction or another, right? Again, I'd go back and look and see how much this would cost me, all right? So I do see a couple more questions pop in. Let me look at those for a second here, but I also want to show you another thing that you can do to help you find potential candidates based on price action, right? Not necessarily a catalyst based on a corporate or a larger. So Thomas asked a kind of a good question, but I don't know if I can answer this in the time that I have. When a stock is hovering high, their volatility is usually low. So I don't not exactly know what you mean. You're saying high volatility, or are you saying high in price? Now, again, it's all relative, but it says their volatility is low. Is a straddle a good strategy, and why? Again, Thomas, what we want to try to find is a candidate who looks like it could have potential for price movement and that there's not a lot of speed bumps in the way. That would be the chart analysis. But we also want to look for candidates that could have a catalyst, one of these corporate catalysts or a broader economics, right? Unemployment or the Fed, right? And especially those candidates that could be extra sensitive to those types. Financials, for instance, are very sensitive to rate cuts and rate rises, right? So that would be one of the things we want to look at. So Myron asked, what is the preferred time frame of charts viewed? We've talked about this in other sessions. I think, Myron, just stick to dailies, right? Just stick to dailies to do this assessment, right? Because the applied volatilities, the way the screener works, are based on daily inputs, right? Not on hourly or 15 minutes, okay? So kind of look at that. All right. So let me see. How are we doing at time, Gene? Oh, we're doing fine. Okay, good. All right, so I'm going to come back to filters here. Now, I already have these candidates. What was that, 19 or 20 candidates? And I'm going to type in candlesticks, candlestick patterns, right? Now, you could do a technical analysis, a Bollinger Band or a MACD or something to that effect. I'm going to add that. And there's a lot of different, we have like 13 in here. So the first two I would jump right on is bullish engulfing and bearish engulfing. And these candlestick patterns are usually found where trend is changing or just as price is about to break out of a particular range. And what this is going to do is now I'm going to take those 19 candidates and look to see if any of them, based on those candlesticks, is going to give me some trades. So I do see a couple here, Ally, T is in there too. So let's just look at those as a chart, right? So this is a bearish engulfing, which means that this red candle is telling us that this uptrend might be over and that maybe price could fall back, right? Maybe back to here, maybe back to here. Or if price breaks out above here, that would be a really bullish sign, right? And it could go back up. So what's the downside here? We're trading around $56 and $55, maybe $3 to the downside, $3 to the upside. What's the cost on this trade? Was that Ally? Yeah, $55. Our cost is right around that value, right? So I have to make that decision, right? Also, again, I would go in there and look for potential catalysts. Maybe there's a corporate event coming, all right? Let's look at T, right? All right, see, this one has already had a big price movement. But again, maybe that what came from an earnings report. So maybe this one is, is past its opportunity. But again, over the next few weeks, as we move further out in time, options might get a little bit cheaper. But if we could break out of this range that was created after this big price, I'm going to guess that was probably an earnings day, that there's a lot of room for it to run to the upside. And below here, definitely looks like, we could see some price movement back down to here. Again, I'd have to go and look a little bit deeper into that. All right. So, a couple of the other ones that you can use, since I have a little time here, there's my bullish and bearish haramis. And there's my Apple. I was wondering what happened to you, Apple. There's our waste management. All right, let's look at Apple. And the reason why I wanted to kind of do Apple is we did this one before in our bear put strategy webinar. We looked at this price, right? Some of you might be familiar to this chart pattern, a head and shoulders, where we were saying that, hey, if it broke down below this neckline, that we could see that price movement, and we did. This might have been a better put strategy than it would be a straddle. But again, the pattern was the catalyst. That's what I wanted to show you on this one. All right. Okay. So any other questions? I see. Any questions that I missed, Jean?
A lot of people are asking if there's going to be a replay of this session. And yes, you will get a link to the recording via email a little bit later on this afternoon. So for all of you who are busy trying to take notes, you are going to get multiple chances to view the webinar again at your convenience.
Yeah, just to remind everyone, under tools, free webinars, this is where you're going to find the library or the catalog of all the webinars that we've done in the past. And for our options traders, where is it? Oh, there it is, preparing for high volatility in long straddle. So you can come back and watch this many, many, many times. I know that I do. One of the criticisms I do get is that I do go a little bit on the quick side, but I want to make sure I get that information out to you guys in the time that we have together, and that you can always come back and slow it down and look at the details of what we just talked about. Okay. All right, I see that we answered most of the questions. I guess we should talk about next week, right, G?
Right. Let's talk about next week, which is a special session.
So what we're going to do next week is we're going to take an opportunity. We did this one in December of last year, and we got a lot of good feedback. And this is an opportunity for you folks to come to our session and ask some questions. And you can be generally specific, especially about how to use Barchart, or if you want to ask my perspective or how my experience of what things that I use or what things that I kind of think about. Just remember that you can't ask a very specific question like, do you think that the stock is going to go up or down or something to that effect? But I would implore to you that we have an opportunity now. Jean, I think I have to go in here to find that information, right? About how to send questions?
Yes, we have a special email address set up, and you'll see it in this in the registration. It's webinar-questions@barchart.com. If you'd like to ask John a question, if you want it to be considered for next week's session, just send us a little email, and we'll add your question to the list of things and see if we can get it covered during the session.
Yeah, definitely send your questions in if that's what you want, because we're going to answer those ones first, and then, time willing, we'll answer any questions that are being brought during that session. Okay, so yeah, I think this will be fun. We did this one about 6 months ago. We got a lot of great feedback about it, and boy, I was really impressed by a lot of the questions that you all brought. So I'm looking forward to that webinar. Okay. Well, look at that. We're right at the top of the hour. So again, I want to thank you for joining us. Gene, thanks for a great session. I want to wish everybody the best of health. Stay safe out there and the good of all trading.
Thank you to everybody for joining us today and for visiting barchart.com. We're glad to have you with us. See you next week. Bye.